Good morning. Thanks to everyone for joining us today for what I hope will be an informative and interesting discussion on all things parametric. I'm not alone in thinking that parametric insurance is one of the hottest topics in the world of insurance innovation at the moment. And I'm pretty confident that if you don't already have that opinion, you will do at the end of this hour. My name is Ed Gaze. I run the innovation team at Lloyds, and that includes the Lloyds Lab, our InsurTech accelerator. We see loads of entrepreneurs coming forward with ideas for parametric products. And we've had several go through our program too with some great success. But what are parametric products? How do they work? What are the challenges associated with using them? Why should you or your clients look twice? That's what we're going to discuss today. So first up, we have a Parametric Solution 101 presentation with Stuart Newcomb. And following that, we'll bring in our other panelists for a wider discussion. So I've got a lot of questions I can ask, but I'd be delighted to ask your questions. So if there's anything that you want answered, then use the Q&A function and we'll try and get to as many as we can. So please sit back with your coffee, notepad, while Stuart provides a 101. Stuart Newcomb is active underwriter for the first syndicate in a box at Lloyds. They're exclusively focused on innovative and unusual insurances, combining the globally recognized brand and license structure of Lloyds of London with the innovation and underwriting expertise of Munich Re Group. He also happens to be a bit of an expert in parametrics. So over to you, Stuart.
Thank you very much, Ed. Asima, could I have the next slide, please? Thank you very much. Good morning, everybody. What I'm going to cover over the next maybe 10 minutes is a quick introduction to parametrics, how they differ from traditional indemnity products, and some of the considerations that you and indeed clients may need to think about in terms of deciding whether a parametric solution may be of use to you. So first of all, why does a parametric differ from a traditional insurance? And probably the key defining change is about how a loss is triggered and managed. And so in a traditional indemnity product, as we're aware, you will have a peril or perils that are insured, and then any losses that arise as a result of those perils would trigger a claims payment process. But the peril itself is not the trigger. It is the losses arising from the peril that trigger the ability for your claim to start. A parametric works differently. It is all about the named peril or the named trigger event. And that trigger event is the thing that starts the claims process running. What happens is the trigger is met, the claims process starts, and the payment is made before there is any real attempt to identify how large that loss may be, because that should have all been pre-calculated at the point of underwriting. There will, however, in many cases be an after the event truing up, which is where we make sure that the payment made under the parametric is a fair reflection of the loss that was actually sustained as a result of that peril. For these things to work, it's essential really that the key point is that we have a lot of data. We have sufficient data to actually model the risk. Because if we're looking to something like a hurricane or an earthquake, we're looking at those historic data sets and the models that can be derived from those to come up with a true expected loss cost based on frequency severity. We also need to match that event to the probable loss of the insured. And the thing here for parametric is that loss is not limited to physical damage only. We typically look at it as all costs arising from that trigger event. So if we look at an example perhaps of a hotel in a Caribbean island that sustains a hurricane loss, it's easy to look at the physical damage to the location, but we can start to roll in things like additional costs of working, loss of income during shutdown periods, if not already covered elsewhere under business interruption insurance, loss of attraction, even additional costs required to regenerate interest in the resort after the earthquake and the repair work has been done. So it's a very wide-ranging claim set that goes into it. The other thing that is essential is that the trigger itself should ideally be third-party and independent. That allows that the claim is not solely under the control of either the insurer or the insured, but we're relying on a third party professional data set to say, yes, this trigger has been met. NOAA, National Hurricane Centre, Bureau of Meteorology in Australia are some good examples of third-party, quite often governmental data, which is truly believed to be independent and therefore non-biased on either side. One thing that's very, very important is managing the basis risk that is associated with a parametric. If we sell a product which has too low a sum insured, or alternatively, the trigger is too high, too remote, then there's a great possibility that the event happens, the storm hits or the earthquake event occurs, but either the trigger is not met and therefore no payment is made, or the payment is insufficient to meet the needs of the client. And the outcome of there is an unhappy client that haven't actually had their bills paid and they wonder what they bought the insurance for. The other side to this, and the one that perhaps raises more interest on the regulatory side, is positive basis risk. If we would have a situation where we offered too high a sum insured on the parametric or with too low a trigger, then either a fairly minor event could trigger a policy, or once the trigger is met, we pay out a sum which is far in excess of the losses sustained, which would result in positive basis risk, or is more often called betterment or over indemnity. This issue of betterment is very tightly regulated in insurance law and also has a specific area of interest within accounting law and accounting principles. So it's essential that we really manage this risk of positive overpayment in the design of the product, in the way it is structured, and especially at time of underwriting, how we make sure that we have correctly matched the peril, the trigger point, and the most probable loss arising from those for that particular insured. You'll quite often see, and in fact, both Lloyd's and Munich Re, as an example, best practice, require us to achieve an independent legal opinion to confirm that the policy we're selling as a parametric insurance meets those requirements of local law and regulation as being a true indemnity product. Asima, could I have the next slide, please? And if you can just open them all, that should be great. Thank you. What we're trying to highlight here is why the customer should buy one. I've explained how they're built and potentially some of the challenges around basis risk and construction, but the advantages to the customer here are quite clear. And probably the two that most people are interested in are the speed and the closing of the gaps. Speed of trigger is key. So we don't have to have the hurricane and then try and get the loss adjusters to come in, make an assessment of the property, draw up their loss report before we can start the claim procedure. The trigger is met, we start the process of paying the money. There is lots of evidence that proves that corporations that are able to respond more quickly tend to survive and actually come back better after the event than those who are not able to do so. So that ability to pay quickly is key. Closing the gaps is the second obvious reason for buying a parametric. And this particularly addresses either uninsurance, where people are unwilling to cover risks, or where there is a shortage of capacity in the market, and underinsurance. And this often arises from natural catastrophe products where people are concerned, and a good example again, tropical cyclones around the coast of Australia. The local market is very averse to this risk, so it's quite difficult to buy that coverage, but you can, for example, buy a parametric coverage to close those gaps. It gives transparency. What is in the wording is very simple to understand. It is if trigger, then we pay. It's nice and easy for everybody to understand. The challenge perhaps sometimes is to make sure that the trigger is expressed in such a way that it's easy for people to comprehend. If we start talking about, modeled wind speeds on best track, how do we make sure we articulate this so everyone is clear? But there's no deductibles, there's no exclusions, there's no write-downs of sums insured. We pay the predefined term sum of money if the trigger is hit. An additional benefit here is that we do have no loss adjusting expenses at the time of claim, and therefore the whole process is simpler and it's cheaper, and therefore that can actually be reflected in the premium as well, because we don't have to factor in the cost of adjusting those claims. What I would say, however, is that the burden for claims tends to fall after the event, in as much as what we would typically see for a large commercial parametric is that we pay very quickly, but at a period of perhaps 6 or 9 months after the event, we will be required to true up the policy, which means the client has to provide evidence that they did spend that money on losses and costs associated with the trigger event. As I said, it's extremely wide-ranging, but it does allow then the proof that is required for regulatory purposes that we've not just sent somebody a large sum of money because an event has been hit, because that may be then deemed to be a derivative rather than a policy of insurance. So key things to take away is that it's only as good as the match between the peril, the trigger, and the loss to be sustained by the client. And that's why at point of underwriting, it's essential that we really get a deep understanding of what that client is looking for, the amount of coverage they have under traditional perils, because this isn't to replace traditional perils, it's to enhance them or fill in the gaps. And that we believe there's a strong correlation between the trigger point and the likelihood of damage and costs being incurred. And in that way, it's a policy that delivers for everybody, and everybody's very clear as to what it is they're likely to achieve through buying this parametric policy. It's a fairly quick run through, but hopefully following this, any further points can come out in the way of questions. And on that point, I will hand over. Thank you.
That's excellent. Thanks, Stuart. So we've got a couple of polling questions. Seema, would you be able to put up the polling questions for our audience, please? There we go. So we're interested in a bit of background. So how many people in the audience have already placed or used parametric insurance? And also, just curious if people have considered using this as a tool to solve client problems. So if you could respond to those, that'd be great, gives a bit of context. And we're going to ask another question at the end of the session too. Now, while you're answering those two questions, I'm going to introduce the rest of our panelists. So Stuart will be joining us for the rest of the session too. But I'd like to introduce Dom Coyne. So Dom, also at Munich Re, is an underwriter for the same first syndicate in the box we've had at Lloyd's. His work, well, the syndicate, as I said before, is exclusively focused on innovative and unusual insurances. And Dom is particularly focusing on things like green energy solutions, weather parametrics, and emerging risks such as autonomous vehicles and new ways of working. Dom also runs a parametric working group, which brings together people from across the market. And we had a session this morning, actually, all around parametrics. So Dom Coyne, we've got Richard Coyle. So Richard, unlike our other guests, is not an underwriter, but he actually works for a cover holder at Lloyd's, a cover holder called Flood Flash. They specialize in parametric flood insurance, utilizing a proprietary IoT sensor, Internet of Things sensor. They're actually in the Lloyd's lab, one of our first cohorts. So Richard leads the production of large and complex risk opportunities, and also manages capacity arrangements with reinsurance carriers. He joined Flood Flash from Lloyd's broker Miller recently, where he headed up the alternative risk team. Richard's key focus was on the production and placement of parametric business across a wide range of perils, including flood, wind, quake, hail, and wildfire. And finally, I'd like to introduce Andrew Borkham. So Andrew joined Chaucer in 1998 and leads the political violence and crisis management team. That brings a bit of a different perspective to our other guests. He began the development of Chaucer's global civil unrest and terrorism facultative and treaty portfolio in 2006. He is also the chairman of the LMA Lloyd's Terrorism Panel and is ACII qualified. Awesome. So hopefully you guys have answered those polling questions. Now, have we got able to see the results, Seema? Okay, nobody's done it before and haven't considered it before. Great. Well, that's the kind of perfect audience for today then, really, because at the end of this, you're going to be chomping at the bit to write some parametric cover for your clients. So awesome. Right, let's crack into the panel then. And as I said earlier, if you guys have got any questions, please drop them into the Q&A and we'll try and get to them. So the last person I introduced was Andrew. So Andrew, first one is being fired at you. What is the role of parametrics within different customer segments? So like consumer, small business, corporate, government, insurer. What do you see as the role of parametrics between these different customer segments? Andrew's picture is currently frozen for me. I think he's been having some Wi-Fi difficulties. Oh, are you back with us, Andrew? I think we're having some difficulty with that.
Does that help? Can you hear me now?
Oh, are we? I can hear you now. Yeah.
Yeah, I think I'll stay with camera off because that keeps interfering with the connection. So within the different segments, I'd say there are significant objective differences and challenges. Obviously, in the consumer space, clients are they're looking for alternatives that give speedier claim payment. Within the
Hi, Andrew. I think we're perhaps struggling. I'll give you a moment and come back to you in a little while, and perhaps move on. Hopefully, you can hear me. So, Dom, welcome. You guys, I know. I mean, as I said earlier. Thanks, Andrew. I think we have a bit of difficulty with your connection. By the way, Andrew is actually on leave and he's dialing in from holiday somewhere, which will probably explain why the Wi-Fi is not so great. So thanks, Andrew. So Dom, what are you seeing in terms of different opportunities for parametrics? Where are you seeing like material traction coming?
Thanks, Ed. We're seeing a lot of traction across the whole spectrum of insurance buyers. So we have products for consumer, small and medium enterprise, and commercial insurance. We'd actually deal with governments within the syndicate itself, governmental organisations, but Munich Re does as a whole as part of their capital partner setup, and there are parametric deals there done with either government entities, state entities, and other organisations. I mean, for us, I feel that parametrics particularly lend themselves to the SME and smaller corporate end of the market because that's where cash flow is important. You often don't have a diversified income base, so that if you are closed for any length of time, you end up closing. So that's where that fast cash flow is particularly important. Because parametrics are occupancy agnostic, unlike property policies, we tend to see parametrics come in where the market is particularly distressed. So looking at a single peril, we'll look at areas where there's a particular windstorm risk, particular quake risk, or particular flood risk. And indemnity markets have often pulled back from offering full traditional stacks. So we might come in either offering whether high deductibles, some kind of deductible coverage in that gap to make insurance more affordable, or we might offer certain coverages that allow the insured to get back on their feet very quickly. So we see traction in areas like strata, so residential homeowners associations, green energy, solar, where for hail coverage, where those markets the insurance markets behind them are particularly distressed. And where cash flow is important on the SME end, we see it in hospitality, flood cover, retail, landlords, things like sports centres. So really, really diversified bunch of potential clients there.
Yeah, sounds like it. Really wide range of things. So quite a lot going on. Richard, you're going to bring a bit of a different perspective, and perhaps you can help answer this next question I've got, which is around barriers to adoption. So, I mean, from your point of view, your experience both at Miller and now at Flood Flash, what do you see as being the barriers to clients taking these products on?
Thanks, Ed. Yes, it's a good question. I mean, I'd say parametrics by nature are, whilst kind of sounding quite exotic, as Stuart alluded to in his presentation, actually the nature of the product is pretty simple. You know, it's if this particular event occurs, then you get paid out X amount of money. So what I've seen, certainly in my time at Miller as a London wholesale broker, and also now at Flood Flash as an MGA, is that the end buyer tends to grasp the concept pretty quickly and is quite favourable on the idea of the product, likes the transparency of it, obviously likes the speed of payout, which is probably the key selling point. And I suppose in terms of, answering the questions, barriers for adoption, not necessarily a barrier, but I'd say a challenge that I've certainly had to overcome in the past is just around, I suppose, the educational process, working with retail brokers to make sure that they're empowered to pitch the product correctly, to their very long-standing, important client relationship. And that's something at Flood Flash that we work very hard on. We've got a really strong broker success team within Flood Flash who work tirelessly to educate our retail broker partners, to tool them up with the necessary collateral, and to train them in how to quote and bind on the online portal. Because ultimately we need to make sure that the benefits of the product are being portrayed correctly to the person who's going to write the check and pay for it. So it's that kind of, I'd say it's a challenge, not a barrier, but it's certainly one of collaboration and working with our producing brokers to make sure that they're fully clued up and aligned with what we're trying to achieve.
Right, thanks. I kind of think this education kind of thing is quite important. We noticed on the poll that most people on the call have never written parametric. There's probably not that much parametric around, and I don't think perhaps much at all in Canada. Then also people haven't really considered it as something for their customers. Stuart, is this common? Is it just Canada? Is it just the Canadian market don't know much about it? Are you seeing the same kind of thing with brokers and clients around different regions?
No, I think it's fairly common. Understanding or awareness varies by region, certainly, but it's something that is growing. I would say actually understanding even within the insurance industry is rapidly accelerating. And Dom and I spend as much of our time speaking internally probably as we do externally to try and educate people on what this offers and why it either may be suitable or indeed not suitable. So I'm not at all surprised by those results. We typically see more of it in areas where they are suffering from perhaps lower frequency but higher severity. So your earthquake, hurricane type areas. Obviously parametric can cover much more than that, but it's probably fairly common in, say, the Caribbean windstorm region and less so in others. But everywhere is seeing a growth in interest from a fairly low base.
Right, so great opportunity to build from, but at the moment there's not many people really know about it so much or are taking it on. Andrew, I don't know if your connection is much better now. I just wonder if you could maybe talk about some of the parametric products you've been working with or developing or experienced with. What kind of things are out there that you're working on? I'm thinking maybe not. Just about hear you, because the reason I was curious is just because your background is a bit different to the rest of the team on the call today. Political violence, crisis management. I was wondering if there's like civil unrest, terrorism. Is there stuff around that you've been able to create parametric products for or had interest in?
Yeah, to date, there's been some interest from clients in the
I think we're going to have to call it
global unrest space
with that one, Andrew. I don't know if you're able to maybe dial in with a phone line instead or something, but you started off promising. I could hear you a bit, and then you disappeared. Just as you got to an interesting bit. Okay, cool. Well, let's move on. Unfortunately, not able to get that insight from Andrew at the moment. So we've covered quite a few different bits, but I'd like to maybe think more about our customers now and think about how we solve customer problems. And I've experienced and seen some parametric products coming to look at not just paying cash, but trying to get people back in the position they would have been. So, for example, with travel policies, maybe getting new flights or something. I was wondering if Dom, put you on the spot here, but could you maybe talk around how we can use parametric products to really solve customer problems, not just kind of see it as a transactional insurance thing that we're doing.
Yeah, I think one of the probably positives to this is that you can build parametrics that directly link with what a client's problem is. I mean, that because of the complexity, the need for detailed data, that's often it sits at the sort of the higher end of the spectrum. So we're talking about large corporates and government entities here, but you can build very well defined data sets that have client input. But on the SME end, on the lower end, because we're often using publicly available data. So for hurricanes, we're using things like the National Hurricane Center data sets. Parametrics are very transparent. So they're quite easy to understand as to when a trigger's been met. I mean, to use Richard's flood flash product, it's based on a sensor that the client knows the height of. So they'll often know if if the water is hitting the sensor that they've got installed on their building, we're going to pay the claim. The claim's going to be that's going to be a triggered policy. So it's really useful to have these kind of easy tangible triggering setups, whereas for an indemnity policy it could be a bit more esoteric and a bit more difficult to understand, especially when you've got a claims adjustment process that sits on the end.
Right. You talked about like public data and stuff there, Dom, and I don't know if this is a question for you or maybe to Stuart, but you can talk a bit more about when you're creating a parametric product. How do you define what data, what's the parameter you're going to be using, and how do you determine that? How do you make sure it's fair? How do you make sure everyone trusts that data? What could you tell us about that?
We look at it from two sides. So the first thing you're looking at is the data you would use to price the product. And that typically is historical data, and it's at the heart of most underwriting now. Unfortunately or fortunately, depending which side of the fence you sit, the days of a very much a judgmental underwriting process where it's all in the art rather than the science are diminishing rapidly. It's much more into the science of actuarial modelling. So what we're looking for pricing is a sufficiently established, stable data set from which our actuaries can build out a pricing model. So there's nothing there that's new or unusual. The trigger piece is more interesting. And what we look for there is third-party, independent, verifiable. We're ideally looking for something that our customer can access in the same way that we do. So they can look at those public data sets and say, that was a Cat 3 storm and it hit the island of wherever. We're confident, they're confident. We try and steer away from anything that involves extensive modeling or analysis beyond the original data source, because that's when it starts to get murky. And perhaps there's the feeling that the customer is less certain about where you're going. To your earlier question of how do you then do true indemnity and put the person back into the position they were before, I think that's going to be the next step of the challenge. So at the moment, for example, we know that the wind speed is hit on a larger policy, but we don't actually know what damage is done, and we don't know where the customer's pain point is. I think that piece there is when you go very much down the scale, and you use the flight example. You could use other examples where the data set has to tell you that the subject of the insurance has effectively ceased to be. So I think it's more likely to relate to physical things when you can then organise a replacement of that physical thing. And you could use, the absolute failure of a piece of equipment as the trigger point, as long as it's independently verifiable. But most of what we're seeing for larger or corporate customers now, the value of the parametric is that it gives them choices as to what they spend their money on. And therefore, that ability to just push an immediate indemnity product to them is more difficult. I think you're looking there much more at the smaller scale. And I think we're not technologically there yet, certainly not anything I've seen, but I know people are working that way.
Okay, right. You talked there about getting the customer back in their position quickly and stuff, and in your presentation you talked about speed. Richard, I hopefully line you up for a good question here, and a good plug for you guys. But I know Flood Flash have been really strong on this, on paying customers quickly. Could you talk a bit about like how you guys have done that? Is it that all parametric products can pay as quickly as you guys do? And if not, what's kind of special sauce that allows Flood Flash to pay so quickly?
Yeah, thanks for the advertising opportunity there, Ed. Yeah, I mean, it is true, and it is the benefit of all parametric policies, whether they are more traditional type, quake or windstorm, or some of the newer type, flood policies, things like Flood Flash does, or even wildfire or hail parametric policies. At the heart of the Flood Flash product is the IoT sensor, which gets installed directly onto a client's property. And it's that bit of kit really that allows for the claim to be paid so quickly. Essentially, it is the claims department of Flood Flash. And what happens is that, as kind of Dom alluded to earlier, the sensor will measure water depth at a given location. And the sensor will communicate back to Flood Flash HQ via the mobile network what those flood depths are. And that can allow for rapid claim payout. I think the quickest one to date of Flood Flash has been in 9 hours and 44 minutes, which for a NatCat claim is actually a world record. And some of the guys actually told me recently that some clients have been paid into their bank accounts without actually even realizing that there was a flood at their property. So yeah, pretty phenomenal, really.
That's really awesome. That's something that the Future at Lloyd's program set out to do when we first launched the blueprint a couple of years ago. Was we were saying we want to pay customers' claims before they know they've had a claim, and so the fact that you guys have been able to achieve that is pretty cool. So you talked about your product being an IoT Internet of Things sensor, and so that's different to some of the stuff I think Dom or Stuart was talking about when they were saying that you use maybe a like an index or something. So your data is very much unique to that customer, right? There's no wider data set they're using.
Yeah, yes and no, I suppose. There's two bits to it. So the data being used for pricing the risk is historical flood data, from the various modeling agencies that exist. And then the data used to pay the claim is derived from the IoT sensor itself, which allows for the quick kind of claim payment. I think it's a good question because, in my time at Miller, I worked on various flood parametric policies, albeit those which didn't have the same kind of technology that Flood Flash does. So we looked at certain deals whereby we were trying to structure a parametric flood product for a client, but using a water depth gauge, which was, in the Gulf of Mexico, a couple 100 meters away from the client's site. Now, the problem with that is that because flooding is such a localized event, the basis risk, which you sometimes hear is a term you sometimes hear bounded about with parametric, was quite large. And what that basically means is that because flooding is so localized, you could have a situation where the trigger on the gauge, which is quite far away actually, is met, but actually there's no flooding at the site, or vice versa, which would be much worse, where you've got flooding at the site, but actually the trigger, because it's so far away on the gauge, it hasn't triggered, so the client's left without coverage that they thought they might have. And what's really, I think, happened in certainly the last kind of 3 or 4 years, is that advances in technology, IoT technology and sensor technology, allows policies for parametric insurance to be triggered using sensors directly installed at client sites. And I think this works really well as long as it's not cost prohibitive. That's got to be the key thing. If you're an SME business and you've got to spend $5,000 on a sensor of some description, then clearly it's not going to work for you. Whereas, where Flood Flash has certainly had success is that we've been able to develop a sensor which is very robust, it's storm-proof, it's got a 10-year battery life, it's fraud-proof, tamper-proof, etc. But it can be installed for as little as £100 in the UK or $150 in the US. So it's really kind of, making parametric flood insurance available for, clients that, 5 years ago, it just wouldn't have been possible.
Thanks. And one more question, Richard. You maybe think is, you talked about the trigger. Is there just one trigger? Like, is it just that trigger of this IoT sensor, and then there'll be a payout, or are there any other checks, anything else that you need to do to be sure that there's been a loss, or what the parametrics should pay out? Is it just that one trigger? Is it that simple?
It can be one trigger. It can be one flood depth, say 20 centimeters, 8 inches, or it could be 50% payout, 8 inches, another 25% on top of that, 12 inches, and another 25% at say 16 inches. So you can structure it in slightly different ways depending on the risk profile of the client. Yes, there are some background checks that happen before the claim is paid. Generally, satellite imagery. We might look at publicly available flood depth gauges that are in various rivers around the world, and even just evidence from the client themselves, photographic evidence. We can use all of that just to validate the claim if we need to. If it looks like something doesn't quite stack up, if the sensor's triggered, but we think there might not be a flood in the area, we can go down that route of just validating it if we need to.
All right, cool. And I open this up to Stuart, Dom, or Andrew. I'm not sure if Andrew is back with us properly yet, but I've got two areas I'd like to cover before we finish. One area is around regulation, another around basis risk. Who wants to volunteer for the basis risk question? Stuart?
Go on, Ed, I'll do that one.
Cool. So, I mean, we talked about, Richard there just said, different depths of flooding, there could be different payouts. Do you think customers, brokers as well, but customers, do they really understand what they're buying? Is there more we can do? Do we need to, help educate them on what they're getting, and that, if your loss ends up bigger than this, you're still only getting disagreed amounts? Do you think there's much of a risk there, or the other way around? They're getting more than what they need? I
think that's probably the greatest challenge when dealing on the customer side is closing that loop. And again, Richard, the beauty of his one is anyone can get the tape measure out of their toolbox and walk around their corporate site and see what would happen if the water gets to 8 inches high. It's very easy to visualize, if I have water to this depth, how much damage I'm going to incur, or 12 inches, 16 inches high. That's the beauty of that product. It's easy for people to visualize. If you're saying to somebody, well, what does a category 2 or 3 or 4 hurricane look like to my property? And it's more than just the wind speed. And similarly with earthquake, if we're looking at Richter scale or peak ground velocity, which is another method we can use to assess, somebody has to do a mental translation to say, well, okay, from that wind speed or from that shake intensity, what does that mean to me? What does that do to my property? We can use all sorts of modeling tools to assess the likelihood of damage, but ultimately it's very personal to that company, that structure, that working environment. And I think that's the real challenge for the brokers, is they've got to make that clear. And again, that point that you could suffer a loss and not have a policy triggered, or vice versa. That is a real challenge. And we do everything we can at the underwriting point, but it's not an exact science because of the vagaries of the effect of what happens if a storm lingers or doesn't linger over somebody's property and the differing levels of damage achieved. But that's a hard explaining. It's a hard thing to explain, and it's probably the greatest challenge in selling a parametric policy.
Yeah, it's interesting because as I said at the start, in the Lloyd's Lab, we've seen quite a few people coming forward with parametric product ideas, and actually, not all of them are from a deep insurance background. And it seems like this kind of logical thing some people are coming out with, and they're like, whether it's like a tornado related or flood related or whatever it might be, we see these things coming through, property related stuff, and it kind of feels like there's a lot of people now kind of like coming up to this conclusion that there should be some insurance policy like this that kind of, and so I don't know, maybe customers over time will actually kind of come to expect this and as an offering, and wonder why they can't get that kind of thing. And I don't know, perhaps as everyone gets a bit more kind of data savvy and tech savvy, they start to think, they start to understand this stuff a bit better, maybe anyway. But I'm just commenting on the fact I see quite a few ideas coming to us from people who wouldn't necessarily have like a strong insurance background. I'm going to move on now to the regulatory side of things, and because I'm not sure if Andrew is got a good connection with us, I'll try him again in a moment. But I'm going to go to Dom, because we were talking about this just this morning, actually, about the regulatory side of things. We can't provide legal advice or anything like that, but and we don't necessarily have the ins and outs of the specifics of Canadian regulations. But what can you tell us about the kind of general landscape we have in terms of regulators and parametric products, and what might we want to be looking at in the near future?
I think in general, if a parametric product fulfills the basic functions of an insurance product, the insured has an insurable interest in whatever we're insuring. It's against a fortuitous event, and they don't get overpaid over the payout is not in excess of their loss. Then in general, we find that the product meets all of the characteristics of an insurance contract. So most regulators have, where we've done business, they've said, or we've been told that the product is a product of insurance. Where it gets slightly difficult is where the product is starting to skirt the lines between insurance and other financial products. So where there is potential for over indemnification, where the insured doesn't have to prove their loss. In certain cases, these are seen locally as either derivatives or other financial instruments, which in general insurance companies can't sell. And the average consumer of insurance, whether they be consumers, SMEs, corporates, can't buy those kind of financial instruments. In general, they're restricted to large financial institutional trading. So we have to be very careful with product design. In general, most insurers, especially within the Lloyd's market that I know of, will take specialist legal advice when designing a product. The other important thing that we have to be aware of, but not particularly that the client or broker doesn't have to be cognizant of, is the accounting status of the product. Again, this is all in product design, but we have to make sure that we can account for products as insurance contracts, taking the various IFRS, GAAP, and whatever it is, financial accounting standards into consideration. So again, this all happens behind the scenes in most insurance companies, but that might mean that in certain cases, clients might not be able to buy the products that they really want because there are accounting standards, laws are very slow moving. I'm hoping that because most parametric products I've seen provide they provide a social good. They're either for situations where there's a natural catastrophe, or providing for situations where there's a protection gap that regulation might catch up quite quickly. But sometimes we have to be really careful and make sure that we're not when we're not breaching any regulation or standards around these kind of products.
Great, thank you. I was literally about to ask a question to Andrew then, he's dropped off completely. So I think maybe that answers my question as to whether his connection is any better. Okay, so perhaps Richard, you can help with this, because having worked at a broker and now at Lloyd's MGA, what would your recommendation be to brokers on how to get up to speed with everything during this webinar? And please do ask questions. But what would your recommendation be to brokers on how to perhaps start understanding more about specific products that are out there, or having conversations with their clients? What would be the key recommendations you would give to brokers?
Yeah, I suppose thinking about flood insurance, because it's such a challenging peril to insure, I think quite often brokers in their conversations with the insureds, will be acutely aware of the challenges that they have in placing property programs that include flood insurance. Based on kind of current market conditions, and what's been a prolonged hard market. Lots of traditional insurers are stripping away flood cover for clients that are in flood-prone areas. So I suppose from my perspective, the awareness from retail brokers about the issue is there. As an MGA, we need to make sure that our retail broker partners are tooled up to portray the benefits of parametric flood insurance to the clients. And we work very hard to do that. So we have various onboarding processes with new broker clients that we're talking to. We've kind of been through tried and tested processes in the UK for the last kind of three years since we've been trading, and are now rolling that process out in North America as well. And it's been very successful. We get great feedback from our broker partners in terms of the product, the engagement with the Flood Flash team, etc. But it is a constant, ongoing educational process just to make sure that retail brokers are aware of the solutions that we do have to address the issues that their clients clearly have. Because if they can't buy flood cover, then they might be able to buy flood cover, but if they can buy it, it's quite often in challenging areas going to be prohibitively expensive. And then for other clients, there could be a real emphasis on liquidity post catastrophic event. We've had lots of calls recently with clients, with their lenders that are also on the call, in order to get lenders comfortable with parametric. And we really are making great gains on that as well. The lenders that we're speaking to are more and more comfortable with parametric as a form of insurance, whereas rewind maybe 5 years ago, that may not have been the case. So yeah, it's certainly an educational process and an ongoing one. But it's part of our kind of BAU as an MGA selling parametric flood cover. So we're very ready and willing and keen to do that with our retail broker partners.
Yeah, that's interesting to hear about having to get the lenders up to speed as well. I mean, Stuart, from your perspective, beyond just flood, I guess, and with a global Munich hat on, are there any bits of advice you would give to brokers on how to engage more with parametric?
I think the key thing for us is to view it as just it's part of a book of solutions they should be looking to discuss with their clients. We do occasionally see brokers come in and they're saying, our client is not happy with the price they've had for their product, so we'd like to break it out, or we want to seek a parametric alternative. If you're looking at mid-size or larger clients, a pure parametric solution perhaps isn't always going to be the best option. So we do always say to the brokers, look at it as part of a product. You could perhaps carry that larger deductible on your conventional program, but infill some of that with the parametric, or you can look to fill some gaps, or you can just do that rapid cash replacement piece. But by and large, trying to move entirely away from the traditional replace with parametric actually creates as many risks as it solves, because of this issue of the risk of not meeting the peril trigger. We always advocate not to consider it as an alternative to, but as part of a suite of. And when brokers, you start to get dealing with brokers who are more familiar, and they'll blend that product suite together with traditional, with non-traditional, with other alternatives to really do the balance sheet protection that the client needs without being reliant on any one of them.
That's great, thank you. Okay, folks, we've got some time for questions. If you've got any questions, please pop them into the Q&A box. We started from a point where a lot of you have never used parametric before, so you might have a lot of questions that we haven't answered perhaps, or maybe there's an area you want us to go into more detail on. If that's the case, just drop a few words into the Q&A box and we'll get on it. I just want to pick up one thing. We did a presentation recently, a few of us on this call actually, to a US audience, and we broke that into kind of consumer and corporate customers. So Dom, you were working with us on that one. I mean, do you see there being much of a difference in the selling products to the consumers versus the corporates? And are the products basically kind of the same, or is there much difference between them to address those different customers?
In general, I mean, for the natural catastrophe products we offer, the actual product structure and how it works, it's very similar. You know, often it's a single peril product, or it could be something like windstorm and quake, or just flood and windstorm together. But in general, there's no real differentiation between the actual structure of the products. We've got the product is triggered by a particular windstorm, particular depth of flood, particular strength of quake. We pay up to a defined payout limit with a proof of loss at the end of it. Now, where it really starts to differ is if we're with essentially the conduct risk implications, the implications of selling direct. So most consumer products are sold direct. So there has to be a lot more work on behalf of the insurer to explain how the product works. For a intermediated product, whether it's a broker and potentially even on the top end, there's a risk manager sitting at the insured's location, working out what he's going to buy, then it's often a very different conversation about how the product's going to work. And people are looking for different things. So they want, for a consumer, they're looking for fast payouts for something that might not be covered. For a large corporate, they're often looking to protect their balance sheet in certain ways, looking to transfer liabilities, for instance, closure or particularly things like cleanup after an incident if they're dealing with hazardous materials, off of their balance sheet and onto an insurer's balance sheet. So they are often very different conversations, but in the end, the product design is the same, the way the product works is the same, and the same considerations sit through the whole structure of the product.
Helpful, thank you. And delighted we got our first question through from the audience from Michael. So maybe I can address this to yourself, Stuart, and give Dom a break for a sec. At what premium or exposure level does the economics of a parametric solution start making sense?
Okay, I'm going to answer some of this and then I'm going to bounce some of it back to Richard because it's all about the distribution method. So if we're dealing, our colleagues in Munich who deal with large corporate, typically looking at around $100,000 minimum premium for them, because most of their products will be bespoke, tailored specifically for that client and individually modeled, and the wording's built for them. So it's not really worth doing for anything much less than 100,000. For 1840, the syndicate in a box, we're typically looking somewhere around the 50,000. We'll go down as low as $25,000 as a minimum premium, because that's, we're then looking at the value of placing a single risk into Lloyd's. If you're getting down to the bottom end of that, then really that's where we look at transferring into the MGA model, where what we seek to do is build once, deliver multiple times. So we look to build a standardized product. We'll pre-build a complex rating model covering wide geographies, and then we'll put it into the hands of a trusted partner to actually deliver that, who are able to work at a much lower premium per risk because of their different operating model, and they're not signing a risk individually through Lloyd's, which is when I pass over quickly to Richard, who'll be able to explain how that works at the bottom end on the, where Flood Flash may wish to sit.
Yeah, makes perfect sense, Stuart. Thank you. And agree entirely. Anything lower than 25k and a purely delegated underwriting model makes more sense from the carrier's perspective. I suppose boiling the question back a little bit as well, in terms of economics of what makes a parametric product work, alongside or in place of traditional. I think it's going to be on a case-by-case basis, but where we've seen success in the past is where you can attach potentially a property program at a higher attachment point. So on the traditional program, the insured is taking a larger self-insured retention. And as Stuart kind of alluded to earlier, what you can do with that higher self-insured retention for a particular peril, say quake or windstorm or flood, is then address that specifically with a parametric policy. So whilst you're self-insuring it on the traditional indemnity side, you're then seeking coverage for it with parametric. And at that point, it's kind of a comparison of how much you're saving on your traditional indemnity premium because the traditional insurers are attaching higher and using that cost saving to then fund the parametric policy. So in that scenario, you kind of get a best of both situation. You've got traditional indemnity, so it's going to pay you, down to the dollar for what you've incurred as a loss. But then you've also funded, by way of premium saving, a parametric policy, which has the benefit of paying you out within a number of days following a catastrophe event. So it's always difficult to answer specific unit economics on a particular deal, but it certainly is that kind of trade-off between indemnity and parametric, using one to fund the other, and then getting an overall nicely blended coverage protection in place.
Really helpful, thanks. A key role for the brokers there to work with insurers and their customers to package up something which responds very quickly, but then also covers them for the full loss that they might have, which is great. Now, Seema, would you be able to put up the final poll question, please? So we're just about to wrap up. We've got just a couple of minutes left. I just wanted to know from you guys, following today's session, are you more or less likely to come to Lloyd's to talk about parametrics? So this is not a formal commitment, it's just a Q&A. But really curious to see if this has been helpful to you. We're hopeful that this has been helpful. We hope that you'll be getting in contact with Stuart, Richard, Dom, and Andrew at some point to talk about this a bit more. But yeah, just want to know if this has been helpful and if you're more likely now to come to us to talk about it. So I'm not sure when we can see the results, but I'll let Seema hopefully update it once it's there. Well, 5 out of 5. That we'll take that as a hit. Awesome. Well, this has been really interesting for me. I always learn something at least one or two things new every time we talk about parametric insurance. But as I said, I think it's one of the most exciting things around insurance innovation at the moment with regards to new products. And I am certain that you'll see some new things launching in the next year or so, particularly from Lloyd's, as we're doing so many different things in this space. If you want to talk to us, I'm sure you can find our contact details through through Seema or through LinkedIn. And if you happen to be in London, come and say hello in the Lloyd's Lab. But thanks for your time, everybody. Have a good morning, rest of the morning, and maybe we'll meet again. Cheers.